Hey everyone, welcome back to the channel. Today we're diving into a major story that's been shaking up one of the biggest names in tech, Google, or more specifically its parent company, Alphabet. If you've been following the headlines, you might have seen that Alphabet's stock recently took a hit, dropping over 6% after news broke about a significant move by the US Department of Justice. So what's going on? Why is the DOJ targeting Google, and what could this mean for the stock? Stick around because we're breaking it all down. Well, what's happening with Google and the DOJ? Here's the deal. The DOJ is ramping up its antitrust case against Google. It's pushing for the company to divest its Chrome browser, which it claims is a major piece of Google's dominance in search and online advertising. This follows a court ruling from earlier this year where a judge found that Google used its market power to suppress competition in the search space. Essentially, the DOJ is saying enough is enough. They're calling for significant structural changes to break Google's grip on the internet. Why is this a big deal? Let's put this into context. Google's search engine dominates the global market with over 90% market share. Chrome, on the other hand, controls about 65% of the browser market. The DOJ argues that Chrome gives Google an unfair advantage by funneling user data directly into its advertising empire, making it nearly impossible for competitors to catch up. If the DOJ succeeds, forcing Google to spin off Chrome could significantly weaken its dominance in the ad space. How did this impact Alphabet's stock? When the news hit, Alphabet's stock dropped over 6%, marking its worst trading day in 10 months. Investors are understandably spooked because any forced changes to Google's core ecosystem could have long-term implications for its revenue streams. That said, it's important to note that Alphabet remains one of the most profitable companies in the world. While the DOJ case is serious, some analysts believe the financial impact of divesting Chrome might be less catastrophic than the market reaction suggests. What are analysts saying? Despite the sell-off, Wall Street remains optimistic about Alphabet's future. Analysts have maintained a strong buy rating on the stock, with a 12-month price target suggesting a potential upside of over 20%. Why? Because Google's strength isn't just in Chrome, it's in its diversified ecosystem. Think YouTube, Google Cloud, Android, and its investments in AI, which continue to drive revenue growth. What does this mean for investors? So, should you be worried about Alphabet's stock? Here's the key takeaway. Regulatory risks like this are nothing new for Google. The company has faced antitrust scrutiny in Europe and the US for years, and it's still managed to thrive. However, these legal battles are a reminder of the risks tied to big tech stocks. If you're a long-term investor, Alphabet still has incredible growth potential. But if you're risk-averse, it might be worth keeping an eye on how this DOJ case unfolds. Wrapping up. To sum it up, Alphabet's recent dip shows just how much weight the DOJ's actions carry. While the regulatory concerns are valid, Google's diverse portfolio and dominance in key areas keep it in a strong position. What do you think? Will the DOJ's push for Chrome divestment actually happen, and how would it impact Google's future? Let me know your thoughts in the comments below. And as always, don't forget to like, subscribe, and hit that notification bell for more updates on the stock market. Thanks for watching.